Good morning, this is Graham Norris, and today is the last day of August 2024. And today I thought I'd go over what internal rate return means. It's an important figure when it comes to large multifamily for the investor. That's probably the first number they're going to ask for because they probably, in all probability, written a goal of what they would expect for a project. So what is an internal rate return? It's a very similar to the cash on cash, but in this case, it takes into account the present value of the investment and the present evaluated return on their investment. So what does that mean? Well, if you imagine that you have an inheritance, okay, and in the first case, you're an adult, you're maybe 40 years old, and they give you the $1 million right away today. And then you have case two, maybe you're only 20 years old and the inheritance has been put in a trust, and they decided you have to be 25 before you before you can draw on that $1 million, and you have to be 30 before you can draw it all out. So would you rather have case one or case two? $1 million today or $1 million in 10 years' time? Well, I think most people would say today, because of two reasons. First reason is the loss of opportunity. In the case two, if I have to wait for 10 years to receive that $1 million, I'm going to lose out on a lot of opportunities to make money with that $1 million. So I'd rather have it today and invest it and get a good rate of return. The second thing is that there's this horrible thing called inflation that will erode that $1 million. So I can guarantee that in 10 years' time, $1 million is not going to be able to buy the same thing as $1 million today is going to buy. So it's important that when we evaluate an opportunity, especially if it's at least 5 years old, that we take that into account. So this horrible formula here, this future value divided by the present value to the power of 1 over the number of years. So if we had a 5-year project, it'd be to the power of 1 divided by 5 and then deduct 1. That gives you the present day value of what that return would be. So if I received say I'll put in $300,000, for example. Well, let me show you. Let me go over to bring up an example on the screen for you. So in this example, we purchase a project at $250. We have repair costs, closing and holding costs, making a total investment of $300,000. So we put that in year 0. So we're out of pocket by $300,000. On year 1, we have the rental, which is the monthly rent after tax net income. And so the annual income in this case will be 12 times the 1760, which is 21,120. So we put that here. Year 2, we do a little bit better and so on. On year 3 and 4, and on year 5, we sell the property for $400,000. So we have the $400,000 plus the 5th year rental income. So these all drop down to the bottom line here. And the nice thing is in function, and that you have a nice function in most spreadsheets of IRR. So you don't have to worry about that nasty formula that I showed you. It does it for you. So IRR and this include this row, do this row as a range, and it'll come to 12.61%. Now we do make a presumption that NPV, which is the net present value, is 0. And in this case, we have the cash on cash is 7.04%, and it happens to be the same as the cap rate. All right, so This IRR, it looks quite a good deal. Of course, that depends on the person, the investor. 12.61% appears to be better than the stock market, and most real estate investments do give you a better return than the stock market. In my view and my experience has taught me, because I lost money on the stock market, but not on real estate. So real estate is the number one place to grow your money. More millionaires are created through real estate than any other method. So 12.61% is above the average market of 10% growth over this period. So, but it can be misleading. So there's a couple of things we've got to bear in mind when it comes to the internal rate return. And that is, these are pro forma figures. In other words, it's the seller trying to predict the future and making assumptions. And one thing we can't do is predict the future. Things can vary. It could be better or it could be worse. So we have to bear that in mind. We also have to bear in mind whether the seller is being optimistic or conservative. And so it's a good idea to look at all the figures, to get a feeling about the IRR. So it's it's like the North Star. It's basically going to show you how to evaluate the project, whether to go into that deeper dive or not. I mean, if a seller's going to put a really low IRR, there's no way that I'm going to do a deeper dive on it, right? I'm going to save myself the time because I'm not into redevelopment and looking for the value add on a reasonable building. We're looking for C-class building and their B-class location. So we're looking for the value add and a really good rate of return for the investor. I know this is all fairly complicated, so a couple of things I'd recommend is you re-watch the video and go over the figures in your mind, practice it on a few offering memorandums that you come across. And if you would like to talk to me about it or ask any questions, certainly put comments in below or book an appointment with me on calendly.com, Graham Norris, and be delighted to go over your questions and some examples with you. But it's important to understand this, and we'll keep covering these topics and make sure that you understand all the terms when it comes to large multifamilies. So we'll talk to you soon. Thank you for watching. Have a great day.